My name is Angela. I'm with Dominion. And first of all, I just want to welcome each of you for coming in person and virtual. We're glad that you're here for our first quarterly lunch and learn. So we're going to be doing this. This is our spring. We'll be doing summer, fall, winter, and so on. So you're our guinea pigs. Thank you for being here. So we have Chris and Brian with us today from Chronicle Partners talking about financial planning and tax for business. So we're really excited to have them here. A couple housekeeping items real quick. First thing is, for those people that are online, there is a place for Q&A. So if you have any questions, it's really important that you post those questions in the Q&A area. There's a separate place for chat, so we do not want to post it there. Make sure that it goes in Q&A so we know to pull those questions. And then when the presentation is complete, then we'll go ahead and go over those questions. And then for those of you in person, you can just raise your hand. You'll ask a question. They'll repeat the question out loud so that those that are on the virtual can hear the question, and then they'll answer that. Second thing is we are recording this. So whether you're here in person or virtually, we are going to send you a copy of this after the fact. So feel free to take notes, but if you miss something, don't worry. You will have a copy of this to fall back on after the fact. So with that, I'll go ahead and have Chris and Brian up here. Thank you.
Thank you. Good morning. Good to see all of the webinar world, I think is what she was saying earlier. So great to see you guys. And I'm Chris. This is Brian.
Thanks for having us.
That's right. I'm excited that we're the first one too. So we get to set the bar. So either really high or really
high or low, it doesn't matter. Nobody knows.
That's exactly right. So, well, today we're going to talk about financial strategies for your business. And so we're gonna take kind of a high level flyover of several different strategies that we utilize with businesses and that many businesses use. And so the idea is, let's save on taxes. I think we all want to try to do that, as well as increase employment, employee fulfillment and retention, as well as strengthen your organization. So with that, we will hop on in. I think our goal for today is not digging really deep into the weeds, but again, kind of giving that high level flyover. And what I would be hopeful for is that everyone walks away with one thing they want to explore, not 50 things to try to implement into the business, but what's one thing that you could explore a little bit more that might be beneficial for the business. So with that, we'll hop in. Today, we're going to talk about a couple strategies, retirement plans. We're going to walk through some retirement plans that will help you save on taxes. Again, going through those pieces of employee retention and fulfillment, and then strengthening the organization, giving through your business. And then the third one is business continuity and succession. And so, again, high level flyover, and we'll go ahead and dig in. And with that, I'll pass it on to Brian to go through the retirement plans.
All right. Thanks, Chris. So like Chris was saying, really there are a few main ways to save on taxes through a business. Retirement plans being one, charitable giving being another, and really just normal expenses through a business. And we won't get into the weeds on, is this deductible, is this not deductible from a business expense standpoint. So I'll focus on retirement plans here, but also I just wanted to emphasize, like Chris said, taxes are usually what brings everybody in the door. We want to be as tax efficient as we can, but we don't want to let the tail wag the dog. You know, you don't want to make decisions based purely on taxes. We want to be practical as well and do the right thing, and be as tax efficient as we can along the way. So retirement plans, obviously through a business, it's a great topic. It's a great tool to serve practical purposes as well as tax benefits. And there are a few different options. You're usually selecting one of these options. The last option on here, the cash balance plan, can be stacked on top of the other options. But through a business, you're selecting a SEP IRA, a simple IRA, and then you see we've got separate bullet points for solo 401k or individual 401k versus just 401k profit sharing plan. Solo 401k is just if you're a self-employed person, a sole proprietor. You can't. It's the same thing. You just have some different rules if you're an individually owned business. So a SEP IRA, you can use this for a business with many individuals as well. You'll generally see it for a lot of self-employed people, individually owned businesses also. Here, you're essentially able to contribute and deduct up to 25% of your net income into an account. And
so one of the things that we wanted to hit on was around the millennial population. How many of you guys employ millennials? So as you guys, so the millennial generation, we're part of the millennial generation, sometimes gets a bad rap because of every 2 or 3 years they generally move on to their jobs. But that's people. One of the reasons that a lot of studies have shown and articles have been written is because they're looking for fulfillment. They're looking to be part of organizations that are doing good. And so one of the ways that we can, again, attract and retain and help employees find fulfillment in what they're doing is through giving. So there's a couple of different ways that you guys and the businesses can do giving. Historically speaking, you'll see a lot of corporations and a lot of companies give through foundations. There, over the last little while, there have been, let's see if I can get through here. There we go. I wonder if we can right this ship here. Okay, I won't touch anything, that's right. So foundations and then also donor advised funds. Donor advised funds are a 501c3 organization, and you can set up a donor advised fund through a company. You can also set them up as individuals. There are some key differences between foundations and donor advised funds. Foundations you have to set up through the IRS essentially. Again, it's a nonprofit organization. There's costs, there's additional costs to it, there's additional restrictions with it from a tax favorability standpoint, but there's also some benefits, larger dollar amounts that are being given, that are being stewarded. Oftentimes you'll see with the foundation, because you can hire people to be a part of that foundation to actually be in charge of stewarding and giving those monies away. A donor advised fund, you don't have the cost to set it up like you do a foundation. You don't have to go through all the rigmarole that you do with the foundation regarding the IRS. You also don't have some of the restrictions that foundations have. Cool. You don't have a requirement as to how much you have to give out per year. That's one of the restrictions with a private foundation. And so donor advised funds just give you more flexibility, and they're a little bit easier generally to work with and work through than a foundation is. And so one of the big benefits with this giving, most people or many people will give cash. And cash is a fine way to give, obviously. Nonprofit organizations are going to receive anything that you give. But when it gets very powerful when you're giving appreciated assets. So when we speak of appreciated assets, we're talking about appreciated securities. So think stocks, mutual funds, ETFs, index funds. You can actually give those to something like a donor advised fund or even a foundation. The big benefit, and this again is where it gets powerful, is you eliminate the capital gains tax that you otherwise would have paid when you give that appreciated security to a donor advised fund or foundation. You still get the fair market value deduction that you would if you gave cash, for instance. You would get the fair market value deduction for that security, but you avoid the capital gains tax. There aren't many ways where you can actually eliminate capital gains tax, and this is one way that you can do it. So you can give more because you're eliminating that tax. So the general idea is, I kind of pause to say this, but I'm saying it anyway, everybody wins but the government, because more is generally going to the nonprofit organization, or more is going to go into the tax savings. So that's a high level of giving. For a lot of the pass-through organizations like an LLC or an S Corp, folks will either set up a donor advised fund or some kind of giving plan through the business. You can also set it up personally. But a lot of businesses will set it up because if they're going to give anyway personally, then they might give through the business for goodwill, to get more illumination in the community. So could certainly be a good way to make an impact, then also save on taxes, employee retention, fulfillment, so on and so forth.
Yeah,
please do.
Just to go back to what Chris was saying about the donor advised fund and foundation. The nice thing of the donor advised fund and foundation is it allows a company to basically, it allows you to better plan around the tax side of your giving, because I think it was implied in what Chris was saying, just to say it out loud, you're generally getting the tax deduction of a gift when you're giving to the nonprofit, to the 501c3. When you have a foundation or a advised fund set up, you're giving to that entity, and then you're able to then stretch out your gift over time. So as a company or an individual, again, depending on how you're incorporated, pass through, C Corp, that sort of thing, you're able to basically give on December 31st, lock in the tax benefit for that year, but then stretch the actual receipt of the gift by whatever entity you want to receive it over a year, the next year or years. So it allows you to do a whole lot better tax planning than, oh my gosh, it's December 27th, we need to get a tax deduction. Let's write a big check to an organization. We need to find out if we want to receive as well. So it allows, it gives you, I won't say stopgap, but it just allows you to do better tax planning around gifts. And maybe too, just to emphasize, Chris was talking about capital gains elimination. The other tax that we're talking about reducing is obviously income taxes. So a whole lot of detail around what, again, depending on how the business is incorporated, you want to make sure that you're giving an appropriate amount so that you are able to receive the deduction, because you can give too much from a tax perspective. Maybe you can't give too much from that perspective. But if you give too much, you might not be able to deduct it all in 1 year. So again, there are different rules for C Corps versus pass-through entities, because you want to be cognizant about how much you're giving.
One of the things that we'll add in right now too is always consult with your CPA.
Should start with that.
We probably should have. So always consult with your CPA. We're talking about a lot of broad tax stuff, but those guys are the ones that we always want to incorporate into discussion as well. All right, we will land the plane here with business continuity and succession. So there is some tax saving pieces to this and how you structure business continuity and business succession. The other part about this that I think is really important is having a well thought out and laid out plan for business continuity and succession helps secure the value and actually increase the value of the business. So the question that I would always start off with it and ask yourself, if you are really any business that you're a part of that you're helping lead, what happens if something happens? And that's just a very simple question that I think we all need to be asking. What happens if something happens? And a lot of people immediately go to, what happens if I pass away? But also, what happens if there's a disability and a key person in the organization can't do what that person does? That could have major effects on the business from a continuity standpoint. So I do want to differentiate. There's two pieces to this. So continuity is if in our partnership, if something happens to me, for instance, then the business continues on, and there is planning that can be done with that. There's also succession. Succession being at what point do you transition or transact that business to somebody else or to a family or whatever the case is. So there's definitely a difference between those two. Buy-sell agreements, you guys might be familiar with those. Buy-sell agreements are very important. Essentially, it says if something were to happen to one of us, for instance, there is an agreement in place, a legal document in place that essentially says this is what happens if something takes place. And so you want to make sure you bring in an attorney with that. You want to make sure that you've got CPA as well. That's going to help make sure that we're making good decisions with these. But a buy-sell agreement is very important. Generally, what you're going to find too is there's going to be insurance funding with the buy-sell agreement. Insurance funding is going to be two pieces. You'll have the piece to have cash to pay a surviving spouse, for instance, if someone passes away, to buy the shares of the business. Then there's also a key man policy. So again, if something were to happen to Brian, for instance, we need to have cash in our business to help fill all that he does and find the right people to replace Brian and his day in, day out operations that he does. And so there's two different pieces of that. We generally have two different parts of insurance. Some people can potentially self-insure it, but oftentimes you're going to see some insurance come into play there as well. And then the last part of that is just a very simple succession plan. We run into a lot of folks that have not asked that question, what happens if something happens? And as business owners and as people that run businesses, oftentimes we get our blinders on and we only focus on what's going on in front of us. And maybe we're looking out forward, but sometimes we don't actually want to look at that question of what's going to happen if something happens. And so a succession plan is well thought out, where you are making those decisions of when do we want to exit? What do we want that exit to look like? What kind of value do we want to have in the business? And there are steps that we can all take to maximize the value of the business, so that if something happens to you, we're not going to have a fire sale, well, I'll leave it at that. And so the succession plan is very important. And again, continuity and succession is a way that you can strengthen your business. Employees and clients, customers are asking that question. Oftentimes, especially as we get older, what's the plan? We see that in our industry quite a bit as baby boomers exit the industry. What is the plan? And so when you do that, you're going to strengthen the business. You will increase the employee retention because there is a plan for that. And again, there are some tax savings, but really in this point, it's more about protecting the value of that business.
I would just say, I think it's about protecting the people too, and because it's, business owner, key person, and member passes away, divorce, disablement, things that can happen. The large majority of the time, there's just no plan in place. Where a plan was drawn up 10 years ago, there might have been insurance funding. Things happen, things change. Even if you put a plan in place today, you need to review it. It's just, it doesn't happen. Chris said most people don't want to focus on it, and it's the same reason folks don't do estate planning. No one wants to think about their own mortality, but it isn't just. It's obviously important for the owner to protect the value of the business for themselves and their family, but there are a whole lot of people that are affected: employees, clients, etc. So biting that bullet and doing that planning is really, really valuable. This isn't a tax benefit almost at all. I don't know. Well, there can be. Yeah, but exactly, there can be, but this isn't something to focus on for taxes. This is to focus on for yourself as an owner and everybody that business touches. It's great.
That's it. So thank you guys. Thanks for having us, allowing us to be here. And I think we've got a little bit of time for questions.
Yes,
perhaps.
Questions.
Okay. You guys have any questions?
I am not a millennial by any means. My question is, when I was that age, looking at giving as my company gave to United Way. Giving to them, I don't know that would have kept me at that job for that reason. So you think this is you look at that piece now and say, I like working here because they give to my favorite charity?
It's a really good. So the question is for the webinar world is, do we think that giving and having a philanthropic side to the business is actually a good retention tool for really anybody, but specifically for in this context, millennial generation. I do think it is, and the reason is that there's been a lot of studies that have been done, and articles that have been written on these studies that do show a correlation between the millennial generation and then staying in organizations longer because of the philanthropic side of that business. What's interesting is that, and this is not every millennial, I'm not going to stereotype that largely, but there is definitely a correlation in that where they will actually take a lesser pay to be part of an organization that has a philanthropic side because it is increasing that fulfillment. So again, that's a large stereotype, but it's something that's come up in recent history. Yeah, sure.
So yeah, I was gonna maybe give a slightly different answer and add in a little bit too. Will that keep employees around by itself, you giving the United way? Probably not. In the same way that 401k match might not keep someone around. But, this is obviously an individual by individual person, or individual by individual basis. How is that person is going to feel really tied to your company? The more you can do, if you do want to kind of look into the philanthropic side, the more you can do to involve them is good. Because if you can say, oh, they don't care about giving to United, they want to give to this organization, or even better, they want to volunteer with this organization. The giving is good. It's obviously good. It's helpful. It's great. But the more you can do to incorporate the employees in that decision-making process, and generally you're probably going to want to spread the giving out then too, depending on how many employees you have, because maybe a couple of them do feel strongly about United Way, the others don't. So the more you can incorporate everyone in the decision-making process, the more it helps.
I think personally that it standing alone is not going to help. Yes. But when you incorporate that into flexible work times, I mean, 2 days in the office, 3 days at home, and hey, we've got this 5K, various things that, based on your company, that holistically it does make a substantial difference. But it's standing alone, United Way or Red Cross, or the list goes on and on and on. Right? Throwing good money after, cannot be. So that's much that you didn't ask for.
But I think getting involved yourself, like you're saying, I thought, well, I'm not going to.
You're right.
So, but doing something that they could participate in, I could see that being a little more willing than just knowing I'm making.
Absolutely. And if you get one that's, across the board, like 3 different things, and say, all right, you 15 guys are on this, and you 15 are on that, and you need to own this. That's kind of the way that they approach us, that you're just not going to show up. You're going to be assigned different roles. And, then obviously at that point, you can decide how involved you are. Because if you did, going back to the 5K, which I'm not suggesting, but you've got 4 or 5 people at your office that would love that idea. You've got 35 that would loathe that idea. But how do we incorporate everyone into it? That's the tricky part.
It's hard.
But it's good. Yeah,
Yep.
It's
a package.
That's right. So the comment for those that are joining us online was that in and of itself, the philanthropic side or the social impact side is not going to keep someone at a job or with a company, but it's the holistic the holistic nature of a 401k, flexible work hours, the philanthropic side, the giving, all of those pieces together is what will increase the fulfillment and increase that retention.
So, the 501c, when they get those, well, I guess they're not considered business owners or whatnot, but could they also make those charitable donations to other nonprofits?
Is so make sure I understand the question. Are you asking if employees of a company can make contributions to something like a foundation or a donor advised fund? Is it?
Yeah.
But if a company is a nonprofit, can their employees do it? Is that what you're saying? A nonprofit company, because that company also contribute towards something like that?
Yes.
Yeah. So the question to sum it up is, can employees of companies give to the nonprofits or to a foundation or a donor advised fund? Yeah.
Or tax deduction.
Mm-hmm. Yeah, absolutely. And so.
And again, there's detail to that to make sure that it's deductible for them personally, because now that's on their individual tax return. That's another conversation. But yes, anytime any individual or business is giving to a 501c3, it's tax deductible as long as it falls.
I'll give an example of that. There's a local mortgage company. They've got a foundation, and they've done something really special where they've incorporated all of the employees that want to be a part of it. And they've asked folks, what's your favorite organization that you want to give to? And so they will do a matching contribution for those, whatever anyone gives to whatever organization they want to give to, they'll make a match. And so it goes back to that kind of fulfillment piece to it. They feel like they're part of something. They're making that social impact. They're doing good in the community. And so the employer and the employees are linking arms together to do that good together. So yeah, it's a really neat way to do it. And there's benefits for the employer, there's benefits for the employees, there's benefits for the community. So yeah, great question.
Another question.
Yes, ma'am.
So can an independent contractor take advantage of the donating and receiving a tax deduction?
So the question was, can independent contractors take advantage of giving to a 501c3 and take the tax deduction? Yes. I'll turn it to Brian.
At the end of the day, we're talking about can a company or an individual reduce their income tax liability through charitable gifts? So as long as you have income from somewhere, the answer is yes. Again, you've got to hit certain thresholds, because as an individual, you have to itemize your tax filing, itemize deductions for your tax filing. Won't bore you with that right now, but the short answer is yes, you can. As long as you're showing income, if you're giving, you potentially can receive tax deduction.
Good question.
Well, thank you both for coming.
Thank you, guys.
Thank you.
And I will add one thing to that as well. Just so you know, before I came to work for Dominion, I looked at 5 or 6 different companies, and I was interviewing and researching. I started following them on LinkedIn. And I tell you, the thing that actually really impressed me about Dominion is how much they volunteer, how much they give. They have their own foundation, the Cameron K. Gallagher Foundation. We have a 5K. And I fell in love with the company by LinkedIn, by seeing that. And that actually wasn't the final decision-making factor, but it did play a big role. And it wasn't just a facade that they had on LinkedIn, but when I came and met with them, I could see that it was really native to the company and to their heart, and it made a big difference. And so it helps not only retain employees, but also attract key employees. So just a little personal note there. No, well, thank you everyone for being here today. We're so glad that you were able to make it. For those of you that are online, we apologize. I don't know if you all were aware, if you saw the flickering lights for a second, but the internet went out. And that did affect our people online. So everything went dark for them. They missed a couple minutes of it, I think. So I'm really sorry that happened. Bad timing there. But for those of you in person, I think you got to, I think it was during that part, some of the contributions. So if you have questions about what was missed, their email addresses are on the screen. So feel free to reach out to them. They'll be happy to answer those questions. Also, and going through the list of attendees, I recognize a lot of you as clients, but some of you I know are not. So I just want to make sure that you know who Dominion is, who this company is that's sponsoring this Lunch and Learn. So just a really quick blurb. We are a full service employee management company. So we work with companies to streamline that employee management. And you think everything from applicant tracking to paperless onboarding, benefit enrollment, performance reviews, timekeeping, of course, payroll. That's kind of the hub that holds it all together, e-learning, and really just anything else you can think of that goes into managing employees and keeping everything efficient and organized. That's really what we do. So if you have any questions about that, we're happy to answer those for you. We also are going to have a key account manager. So I know a lot of clients that like to be able to meet our staff and be able to ask questions in person. So we are, as soon as the door opens, we do have a key account manager standing outside the door. So feel free to introduce yourself, ask questions. And again, we appreciate you being here today. Have a great rest of your day. Thank you.
Thank you.
Thank you.